What's up, everyone? Hope all is well. Here with another video with some information that I hope will be helpful to you on your investment journey. Before we get into it, I'd like to take care of a couple of housekeeping things. Number one, if you find the information I'm sharing helpful, please consider subscribing to the channel. Also, while you're at it, do me a favor and smash that like button. Really would appreciate it. So, let's go ahead and get into it. Topic for today: top 10 mistakes you will make as a new investor that you shouldn't. And hopefully by sharing these mistakes, you'll be able to prevent yourself from making some of the same mistakes that I've made and that other people have made along the way towards becoming proficient investors and traders. Number one, attempting options trades or advanced strategies too soon. A lot of people get into the stock investing and they jump right into investing with stock options. And if you're unfamiliar with stock options, options trading is a little different from traditional investing in stocks. When you're traditionally investing in stocks, you're buying the actual shares and you're selling the shares, and you hold them for a certain period. When you're doing options, you're actually not buying the shares. And I'm going to explain this very simply because I think a lot of people explain options in a way that's overly complicated for no reason. So on a basic level, when you're buying options, you're basically betting on whether or not the stock will go up or down. You're predicting the direction of the stock, okay? So with an option, if you think a stock is gonna go down, then you buy a put. And if you think the stock price is gonna go up, then you buy a call. And you can make a lot of money if you're correct. So if you do an option and you're correct on the direction and the time frame, you can double or triple your money in a short amount of time. Some people call that considered almost like gambling, but you can double, triple your money or even more in a matter of a day, a couple weeks, or months. It depends on the time frame that you're using. However, if you are wrong about the direction, or even if you are right about the direction but your time frame was wrong, it took longer than you predicted, you'll lose all your money, or you stand to potentially lose all your money. So you can be options trading and be correct several times, and one or two bad decisions can wipe your account out. And for that reason, it's a strategy that you should not use until you're more advanced and further along your journey. I think newer investors should stick with more traditional investment strategies starting out. Number two, for people who are ready to invest with stock options, the second mistake new traders make is buying options with short expirations, okay? Your expiration is your time period. So when you're predicting your stock direction and you think it's going down, so you buy a put, or you think it's going up, so you buy calls, the mistake a lot of people make is they do short-term expirations. So you're buying options with a 1 week expiration, 2 week expiration, a 1 month expiration. Those are very difficult options to execute. And if you're more experienced, or at least I will say, if you're more efficient, you'll have longer term options. So a common phrase people will use is make sure you buy enough time. You really have to buy time. I wouldn't buy an option that had less than 4 months. That's personally 4 to 6 months even. And the sweet spot, in my opinion, I'm most successful when I do leaps, which doing leaps is probably a whole separate video. So that's just enough. If you're kind of getting into this space, you should know what leaps are. But short-term expirations, you're playing with fire. Number three, revenge trading. Revenge trading. Another mistake people will make when you're newer to investing. So let's say you were impatient with one of your investment moves and something didn't work out, you lost money, or maybe you closed. Actually, the most common thing is someone panic sells. So you panicked, you freaked out, you sold for a loss, okay? Maybe you put up $2,000 and you lost $700. So now you're down to $1,300. All right, a common mistake people will quickly look for the next thing to jump on right away to make their money back. That's called a revenge trade. That's a terrible idea. Typically when you're doing something like that, your emotions are not in line. You're thinking with emotions as opposed to logic. And if you're doing revenge trade, you're at risk of losing all your money. You may lose the remaining 1,300, or you just may continue going downhill, downhill, downhill. And I've seen those accounts where people reflect in 2-3 months and say, man, what happened? I was at X amount and I had a few bad decisions and now my account is a fifth of what it was before. Be very careful for revenge trading. If you find yourself upset, frustrated, walk away from your screen and stop trading for a while until you can get your head together. I've said this before, and I think we'll touch on it today, but having your mindset strong and correct is one of the most important aspects of being a good investor. Number 4, common mistake made by new investors is making investment decisions based on the earnings report dates. All right, there's a lot of people who follow when companies are announcing earnings. And during earnings seasons, you have different earnings reports every day. And so each week you look at the earnings whispers and you see what's coming up and who's making a big earnings announcement this week. And it is exciting and it's good to be aware of what's coming up, particularly for stocks you already hold. But a lot of people will buy stock options, calls, or puts purely based on earnings. And there are a lot of technical reasons why that's hard. Number one, the implied volatility and the cost, the spread difference and the cost of your contracts will be a lot higher just because of earnings. Okay, so that's number one. And if you are buying call options, let's just say, and again, this is options talk. If you're buying options for the purpose of earnings, the company can smash their earnings out the water and just meet all their projections, right? Sometimes the stock does not always move in correlation to the news. It doesn't always make sense. A notorious example is Apple. Apple is notorious for going down after a positive earnings report. So if you bought the call option thinking you're going to make money on earnings, you can still lose even though they beat earnings. It can happen. Also, sometimes the company can hit their earnings, but the guidance for the next quarter may be weak. They're projected to not make as much because of, let's say, coronavirus or shipping and receiving challenges in the Suez Canal. It could be any little thing. And because of the reduced future or the lowered guidance for future quarters or projections, it can go down because of that. There's so many different things that can affect the stock in a way that you don't anticipate. And for that reason, earnings trading is considered to be pretty risky. Would not recommend that until you're more seasoned in your investment journey. Number 5, common mistake that new investors make is chasing hype stocks, chasing the hype and looking for the next big trend, the next big thing. And a relevant example of that right now is the saga that took place with GameStop and AMC, the movie theaters, or Cruise. Those are probably the biggest two. But if you're just looking for something that's just the flavor of the month, something that's just in the news or there's a lot of hype surrounding it for whatever reason, then that's typically something that's going to be risky and that's not consistently going to deliver you the positive results you want. So be very careful chasing hype and chasing just something that happens to be in the news. Try to do your research, and most investors are going to fall into one of two categories. You have your fundamental investors and then you have your technical investors. Your fundamental investors are going to look at the company and look at their profit and earnings ratio. They're going to look at what their earnings have been each quarter for the last 5 years, what's their current debt load, how much revenue are they projected to make, how much revenue did they make the previous year, who's their C-levels, from the CEO on down, what's their product line. They're just looking at all of those financials like an MBA would, and they're analyzing and making decisions on what to invest in based on those fundamentals. That's pretty much the Warren Buffett model, okay? Then you have technical traders and technical investors. And the technical investor isn't as concerned about the company earnings and the reports as much as they are about analyzing the stock the stock chart. So you can look at a stock chart, and there are just hundreds of different indicators you can use that can essentially give you estimates on where the stock is going based on moving averages. That's a gem right there. So you can look at the stock chart, the moving averages. You can draw different Fibonacci's and isosceles triangles, different things you can do on a chart and analyze it, and you can do pretty well predicting where it's going by using those indicators, slope and resistance, things like that. I actually fall more on the technical side, but I'll say a combination. I'm probably 75% technical and then 25% fundamental, but it's a lot better for you to find your fit in those areas than it would be for you to chase hype stock. Number 6, common mistake new investors make that you should not make is I found a lot of newer investors tend to make major purchasing decisions based on the opinions of everyone else. So they ask a lot of people, hey, what's your thoughts on this? What do you think about this? What do you think about this? Or, give me the stocks that you're looking at right now. And that other person may have done their due diligence. They may have done their research, and that's why they decided, hey, I'm really a big fan of these companies and these stocks, and this is why. The newer investor tags along and buys the same thing based on the other person's opinion and research. And I've found they tend to jump around looking for the next guru or the person with the magic pill or the magic beans to give them the secrets to all these amazing stock picks every time. Once you get more experience, you really want to start to lean on your own research. And it's okay to have mentors, and it's okay to have people that help you and guide you, but you want people to show you how to analyze things yourself so that you can come up with the best investment strategies that make sense to you. So, at some point, that's your goal. The goal that I always have is teach a man how to fish, teach a woman how to fish, and then you feed them for life. So don't always depend on someone else to give you the jewels every time, or you're never going to be self-sufficient. Number 7, common mistakes made by new investors and new traders. Panic selling and then FOMOing back into the stock later. Okay, FOMO is a common term we use. It means fear of missing out. And it goes back to controlling your emotions. So panic selling. Some of the best investments I've ever made have dropped significantly at one time. You put all your money down. Let's say you put down $2,000, and something happens in the news, and temporarily it drops 50%, and now you're down to $1,000. All right, the experienced investor won't sweat it, and they'll just ignore it and wait for it to come back, and it might come back in a couple weeks. Or the really good investor will double down and put extra money down on it so they can dollar cost average, lower their average cost of purchase price, and that will increase their profits. Okay, the newer investor will panic sell, and they'll start to panic and flip out, and they'll sell it for a loss at the $1,000. Then once the stock starts to rebound, they FOMO and say, oh my God, I'm missing out. It's going back up. And now they buy back in higher. So they've lost money on the sell, and they bought back at a higher price. So they've killed their profits, or at least reduced the profits they would have ordinarily made. Plus you might have had an additional taxable event from selling early. So on the full circle, you just made a lot of mistakes. So you really want to avoid getting too emotional. The best stock charts have ups and downs, and valleys and peaks. Okay, and it's just like life. I found that people want to feel comfort knowing that you put your money down on the stock and it's going to go straight up over the next 2 years, and you'll make all this money. That's not how it works. It doesn't happen that way. You're going to have down periods, and you have to ride out the down periods and just have confidence in your analysis that it's going to come back up without panic selling and then FOMOing back in at the very top of the chart. Number 8, common mistakes made by new investors and new traders. This is a big one. Number 8, attempting to pick winners and individual stock winners before building up a portfolio with index funds and ETFs. All right, if you're new to investing, and that's a beautiful thing, the first thing you should be doing is building up a portfolio using index funds and ETFs. Index funds are basically a way you can invest in multiple companies with one share, and it limits your risk and prevents you from having to choose winners. The index funds that everybody should have are an index fund that invests in the S&P 500. The S&P 500 are the 500 largest, strongest public companies in America. Warren Buffett says the S&P 500 is like betting on America. So the 500 strongest public companies are all in that one index. A common one that I typically will recommend is Vanguard. They have some really, really good index funds. The one for the S&P 500 is symbol VOO. All right. I use Schwab for my other accounts. Schwab has one as well, SWPPX. Both of those have very low fees, like 0.02 and 0.03%. So it's very low, minimal cost, and that'll deliver you really good returns over the long haul. Just doing that one thing. If the average person, even if you make, regardless of whatever your salary is, if you buy shares in the S&P 500 on a regular, consistent basis for 30 to 40 years, you'll statistically end up a millionaire in most cases, even if your salary, even if it's a percentage of a $30,000 to $40,000 salary. That one thing will return you an average of, I think, at least 8% per year. So you want to do that first. And once you have the index funds, you can venture a little bit further into the ETF space. An ETF is an exchange traded fund, and it's similar to an index fund, but the difference is an ETF can focus on a specific industry. So if you're interested in the marijuana industry, there is an ETF. Actually, there's a couple of them for the marijuana industry. Two of them I'm thinking of offhand are MJ and YOLO, YOLO. So it's a way you can invest in that entire industry with one share, one stock, that one ETF, without having to decide which one of these 20 marijuana companies are going to be the leading company that's going to make us the most profit in the future. You don't have to worry about making that prediction. You can just buy the ETF, and now you're invested in that sector. And the ETF's managers will automatically rebalance that ETF every 6 months, so that the strongest performers are getting a higher weight than the lower performers. Okay, there's ETFs for any industry you can think of. You got ETFs for real estate, for REITs. You got ETFs for cybersecurity. There's a good symbol on that one, HACK, hack. So ETFs are a great way to invest in an industry without having to pick winners. So those are the first two steps everybody should do first before you start trying to figure out what's the next Amazon, or what's the next Tesla, or whatever, or what have you. Get your index funds and your ETFs squared away first. Number 9, common mistakes made by new investors and new traders. This one might surprise some people. Investing in stocks with a brokerage account before building up a healthy retirement portfolio. Building up your retirement portfolio is the first most important step. And what I mean by that is, my rule of thumb is 10%. So wherever you work, if your company offers a 401k, and they do a match up to, usually it's half of a certain percentage, so they may match half up to 6%, you absolutely have to contribute at least as much as you can to maximize the matching portion. You have to do that. That's free money towards your retirement that they're giving you. That adds on to your overall compensation package. But beyond that, my recommendation is at least 10%. You want to always put at least 10% away for your future. There's a really good book that breaks that down called The Richest Man in Babylon. It's an ancient principle, paying yourself first. You always want to do that 10% first to get your retirement portfolio at least in a position where you're maximizing it. On top of that, if you're younger, I'd say under 40, you really want to consider a Roth IRA. Roth IRA is one of the best retirement vehicles you can get, and there's so many reasons why. I might do a video just on the Roth IRA alone, but I opened up mine. I wasn't even quite sure it was the right thing to do at the time, but that one thing was one of the best financial decisions I have ever made. The Roth IRA is amazing. Changed that one account has changed my life. Like again, there's a lot of reasons why in terms of the tax benefits. There's so many different flexibilities it offers. So I'll have to talk on that at some point. But if you can max your 401k, or at least get up to 10%, and set up a Roth IRA and try to contribute as much as you can. I get that it's hard for most people to max out the Roth IRA because you're allowed to contribute at least $6,000 per year, which is a little over, I think that's $500 a month. And I know it's a lot for a lot of people. So do whatever you can. But if you at least have a Roth IRA and your retirement account you're contributing at least 10%, then you have a solid foundation to proceed in investing in stocks. But I would not recommend you do that. You invest in stocks first until you have your retirement in a good place. Finally, number 10, this is the most important one, so I saved it for last. The top mistake most investors and traders make that are new to investing is not controlling their emotions and having in their psychology with investing. Controlling your emotions is the most important thing you have to know in order to make money investing in stocks. Being a successful investor and profiting is 90% psychology and 10% execution. You can have the best plan, but if you're too emotional and you panic sell during temporary declines or you FOMO in at the worst prices, you're not going to make money. Okay? A good example of that, anybody who's been an investor, remembers what happened last March in 2020. I could almost break it down to the day. It was around March 15th or 16th, but last March, every single stock in the market just tanked horribly. And a lot of people panicked and sold and flipped out and ran for the hills. And in hindsight, what we know now is that was one of the best days to buy stocks that I can remember in a long time. Almost anything that you would have purchased last March is double or triple, no matter what it was. UPS went skyrocketed. Amazon skyrocketed, AMD skyrocketed, Shopify skyrocketed, just anything, everything. So when everyone was panicking and selling, the smart people who were purchasing at that time made a lot of money just by remaining level-headed and calm, even if your portfolio was down, adding on the additional funds you might have on the side if you were able to, because I get a lot of us were struggling during the pandemic and lost our jobs. But the people who were still okay and able to invest made a lot of money, okay? So control your emotions and don't panic and flip out over temporary issues, because over the long term, we always rebound and end up higher than we were before. So that's it for today. Again, hope the information was helpful. If you found it beneficial, I consider subscribing to the channel. And once again, I would definitely appreciate a big smashing that like button, the thumbs up, to let me know that the content is benefiting you, and that allows someone else to be able to see the information. Thanks again. Till next time.